Hi, everyone. If you're ready, we'll get started here. My name is Brita Rosenheim. I'm an investor in food tech at Better Food Ventures. We invest early stage in food tech and ag tech. I've been looking at this sector for the last 10 years. It's been really interesting and exciting to see so many cycles over the years of kind of strong and or weak business models, the emergence of new business models that never existed, new technologies that never existed, and I still think we're really at the infancy of the food tech sector in terms of the potential. I'm really excited to have three different perspectives here in investing in this space who have also been looking at various lenses of investing in food tech for a number of years. And so we're going to do a couple of deep dives around investment thesis and then bring it out to a moderated discussion. So we'll start with Brian over here. Brian, he's, I'm sure most of you are familiar with Brian. He's one of the original personalities of the Smart Kitchen Summit from the get-go. But for those of you who don't know Brian, can you talk a little bit about the background, your evolution, how you got into food tech, and what does FTW stand for?
So, hi, everybody. For those that don't know me, Brian Frank. I run FTW Ventures out of San Francisco. We're a micro VC focused on science and technology to move the food system forward. How I got in this space was much like the founders in the room. I spent 20 years building early stage startup businesses. I love going from 0 to 1. I love having a concept, taking it all the way through coding and implementation, and in some cases physical product and taking that out to market, and then really interacting with customers and users. And so for 20 years, I built a number of different startup businesses. I've counted 6 different startups I've been a founder or a principal executive at, and I've sold 3 of them. So I'd say batting average of 500 is not bad in the tech world.
That's good.
Yeah, from the VCs of the panel, I need to make sure I got my cred now. And so several years ago, around the same time that Mike was thinking about this show and the original thing, I started about switching out my career from being a tech founder to getting on the other side of the table and helping other tech founders make their dreams come true and change something about the world. And so I realized the next evolution of my career was having an impact and making money was a good thing to do together. And so I picked a market that I didn't feel like there was a lot of attention being given to in food and food tech very early on when Impossible Foods and Beyond Meat were just getting started, and things like Creator, the hamburger robot, was like a gleam in someone's eye, right? And so I felt like I got in very early, and I was very lucky. I picked the right place at the right time. And then when I looked around me and I saw people like Brita and other people that were already in this space that were looking at investments, like, okay, there's a lot of other really smart people, but not a lot of us, right? I mean, in the early days, there wasn't many of us. And so I kind of grew up with this whole space, and now I feel like we're getting to the turning point where 500 or so people will show up at an event like this, and thousands will show up at CES, and like everybody's talking about the Impossible Burger, at CES. That was the breakthrough at CES. And so like I feel like a little pride that we've, as a team, have built, kind of that environment. So FTW. So FTW originally started as Food for Thought Worldwide, so thinking about the food system and making it a worldwide phenomena. But all my millennial founders like to call it For the Win. And I was like, oh, that's great. So I think I'm going to change it here officially. It's now For the Win, officially.
I'm glad I asked.
Yeah, so if we can do good in the food world for people, the planet, and profit, we've won, right? And so that's what For the Win to me really means. And for those of you that are old fogies like me and the rest of this panel here, we remember Hollywood Squares, and like you'd always take that center square for the win. And so like getting those 3 things in alignment, is kind of where I see the vision of that.
So I think that's great background to, I had one of my questions for Brian, he pushed back on a little bit, but I'm still going to ask the same question because I do think it's worth speaking to, kind of the evolution of the opportunity in this space. And so since I first met Brian, every time we talk, we always see each other here. We often see each other at other events throughout the year. But I've been kind of excited to see the expansion of his investment focus grow over the years. And when I first met him, it did feel kind of a lot more consumer focused, hardware focused, categories that I personally wasn't looking at with as much enthusiasm. And increasingly. The categories that you're looking at are kind of broader, going all the way into ag. So do you want to talk a little bit about, I'm going to say the evolution of your investment thesis. You're going to say it's been that the whole time?
Sure. So, and I'll address the question. Originally when I started investing in this space, and the origination of this conference was all around consumer technology. We were all really excited about consumer technology and how our kitchen was going to change radically because all of our equipment was going to talk to each other. And look, we're 5 years later, and we're still seeing the same enthusiasm, but the same topic being discussed. And so I originally had started in consumer applications and services because that's where, as an entrepreneur, that's where my love was for product, was figuring out consumer problems with the way that they relate to technology and helps them live, work, and play better, right? And so that was originally the main part of my thesis, but then I've shifted more away from the consumer market because we've seen, a lot of notable failures in that space. It's really hard to build a consumer business, and Nate will talk about this, having built a consumer business. It's very, very hard and costly and time-consuming to change consumer habits or get people to buy a consumer product and working with things like retailers. And so I've shifted more of my investing focus away from the consumer and more towards commercial and industrial opportunities. And I think the shift of this show also shows that. Like, we've now expanded the show not just to handle consumer problems and services, but also what happens at a restaurant, what happens at a retailer, what happens in the supply chain, which, by the way, like, I was talking to someone from Sweetgreen today. Oh my gosh, how much food product gets moved every single day, and thinking about the logistics and the problems and management and waste and all these things within that. It's underinvested and undermanaged. I know you're probably going to talk about this, Tom, in terms of like, holy crap, basically AB is just one big supply chain problem every single day with moving product and making product and getting it to market. And so we've now kind of shifted our thinking in towards there's so many different problems going all the way back to the farm. And even I would say there's traditional farming and there's modern farming, right, and modern agriculture. And so when we talk about modern agriculture, little plug for my next session after this is molecular food. Like, we're rethinking food at the molecular level. And so the idea that science and technology can upend the consumer experience, I think, is interesting. I think it's a hard challenge to build venture scale, and we heard that term in the last panel, businesses. But there's so many other venture scale opportunities throughout everything within the food industry. So we're now very, very broad from that perspective.
So so that's a good segue to, how do you think that your lens on investing is different than a traditional tech investor or a traditional food investor?
Yeah.
How are you approaching the space uniquely?
Great question. So I call ourselves a problem-focused venture fund rather than a tech-focused venture fund because I don't want us to be pigeonholed as one technology to solve the problem of food. It's not true, right? Food is a biological and chemical process that then gets produced and manufactured through hardware and automation more and more these days. And it's a software problem to find where our next meal is coming from because we're going to hit Uber Eats or we're going to hit Caviar and things like that. And so I don't think there's any one technology to rule them all. I think you actually have to look at it from the what problem am I trying to solve and then apply the right technology to that problem. And so I love my brethren that are hardware-focused venture funds or software, B2B SaaS. I was meeting with someone today that was like, I'm B2B SaaS. I'm like, that's cool, but that's a technology. That's not a problem, right? And so what are you trying to solve? And let's start there, and we can get on the same page about that. And so that's why
I think that also, to interrupt quickly on that, I think that's also where there's been a lot of challenges and, a lot of and I'll speak a little bit more about it later, the guys who are kind of go big or go home, but not focused on a problem, they were focused on a technology. So I think that speaks to a lot of the failures in the space as well.
That's right. Focus on a problem, focus on the customer, like what they need, and then use whatever technology makes sense, right? And so that's how I think, one, we differentiate ourselves from the typical Silicon Valley investors that have this, some of them, very narrow kind of technology focus. But we like working with them because their experience down those paths is very, very deep. And so if we're going to get into a hardware business, I want a partner that comes from a hardware-based venture fund that can help with scale up of manufacturing and understanding of going to DFM and things like that. And so we don't ever tell anybody, like, we're the only capital you're going to raise. In fact, we should put a really good board of investors and advisory group around you that accelerates you, the founder. And so my goal is to be the food and strategic guy in that, what I would call horizontal, and then we always want to bring in the right blades of verticalized, focused investment and strategic help that can help those companies down that specific path.
Yeah, that makes a lot of sense. That's also how we think about the world as well. So I concur with that approach. All right, we're gonna switch it up. Nate.
Hello.
He just. I think I'm allowed to say the name. No, I'm just teasing. So he's launching a new VC fund called Union, but due to SEC guidelines, he's limited on what he can say about it. So what can you tell us about?
Yeah, maybe the first thing is So I'm Nate Williams. I'm the EIR covering hardware at Kleiner Perkins, the venture capital firm responsible for Nest and Ring and Genentech and Amazon and Google. I've been there for 2 years. My last company was August Smart Lock. That was a leader in the smart home category, was bought for a reported $150 million 18 months ago. One of the things that I noticed, and Brian and others like Michael Wolf have been great friends and mentors as I've gone through this journey from being an operator, entrepreneur to an investor. When I first got into Silicon Valley in 2005, I took a look at what was happening in the market, and that first company that I was part of, For Home, was an early innovator in home automation. That company was bought by Google. When I got back to Kleiner Perkins, something shocked me about how much venture capital had changed. And so we're all entrepreneurs or operators here in the room. It's important to understand, if you take venture capital money, how the market's changed. So we take 4 main points over the past decade, how ventures changed and what that means to you. Here they are. Number one, venture and private equity as an asset class has gotten much bigger, ginormous over the past 10 years. We have funds like the SoftBank Vision Fund, that's a $100 billion fund. We have sovereign wealth funds, we have others. Okay, so that's a lot more money. So what does that mean? Most of the larger venture capital firms have become much more passive because they have to invest more money per investment, and you can only sit on so many boards. And so that's created a little bit of dislocation at early stage. How do you find an investor like a Brian who can really be there as your friend, your helper, help with the supply chain, go to market? Second thing was, you just mentioned about B2B SaaS. If we look at the people when I first came out of graduate school at UCLA who wrote checks, they came from places like Cisco and Oracle and Netscape and others. So they were super technical. They understood networks. If I told you that 90% of the check writing partners now come from backgrounds, social, mobile, local, or SaaS, they're at Facebook, they're at Uber, they're at LinkedIn. Those are great companies. But if you're building a food robot and you have to think about where you source your components, issues with China versus Vietnam, moving from Foxconn to Newkempo Group, that's very difficult. Part 3 is around corporates. So we have some corporates here in the room and on the stage. The issue regarding corporates is over the past 10 years, we've seen an intermediation, meaning that traditionally corporates spend time with venture capital. Hey, I'm Walmart. This is how I think about the world, supply chain, Bossa Nova, et cetera. But now what we see is they actually speak to their corporate venture capital arm, or they actually speak to a partner who's not a check writing partner. And so I would argue that venture as an industry has lost the contextualization of the channel. So if you're selling a product through retail, you really have to spend time at a Bunnings in Australia or a MediaMarkt in Germany or a Dixon in the UK. And the last is what really affected me and my co-founder as entrepreneurs who've built and sold multiple companies is the time it takes to get from an initial founding of a company to product market fit. We've seen more time, more pivots in the serpentine road. And so the reason why we created Union as a spin-out fund from Kleiner Perkins was really about uniting some of the best Fortune 500 companies who are investors in our fund, uniting some of the best seasoned entrepreneurs, folks that have built companies like Sling and Nest, Cisco and others, and then ultimately with the entrepreneur, where the entrepreneur has a partner to build faster. And so that's what we're doing. Unfortunately, as Brita mentioned, because of SEC rules, I can't talk about how big our fund is and when we're launching.
Not yet.
Yeah, sure.
So you've had over a decade in the connected home space, the smart home space. Hardware is hard. You've looked at hardware from a number of angles. What keeps you interested in this category? Do you think that times are changing for a hardware startup? Are there more opportunities? Is the skepticism deserved? How are you an advocate here, and how are you pushing forward for the space?
Yeah, I mean, number one is to be an advocate for the entrepreneur. Yeah. Everything we do on this side of the table is in support of entrepreneurs. So that's rule one, is you really need to take money from folks that have been through the journey and can take them, walk in your shoes, understand how to hire, how to build scale, how to think about exits, all those things happen. In terms of hardware, when people ask me, I make the analogy, hardware investing or building a hardware company is a lot like gymnastics or high diving. there's two components. There's the degree of difficulty of the dive, and then there's your execution. And so one of the things about hardware is it's extremely hard to execute well, right? It's not just like you have a website and you can A/B test your content and you can take it off. The previous panel talked about lean startup methodologies. To be honest, lean startup is bullshit when it comes to hard tech investing. You don't want lean startup. Thank you. That's one of the things to be mindful as this market changes. When you superimpose SaaS metrics on hard tech companies, you have some really dangerous outcomes. And so everything from the start of building a physical product is different. Who you hire, how do you go to market, how you capitalize. Now that being said, when we think of some of the successful companies out there, companies like Tesla, Peloton, Apple, et cetera, there's a reason why it does make sense. I'm a big believer in the following 3 criteria for teams we want to work with. Number 1 is TAM, total available market. You can't build a venture scale business in a tiny nascent market. You need a big market, right? Access control and identity worldwide is a $100 billion market. Home renovation, home construction is a big market, so TAM. Second is team, right? At the end of the day, whether it's Brian, Tom, Brita, myself, John Doerr from Kleiner Perkins, you invest your money in a team and they make 99.99% of the decisions. So at the end of the day, the company that you talk to me about investing becomes a different company within 3 months of us writing a check. And having that faith in the team to learn, to fail, to grow, to regenerate is really important. And the last one is really around product chops. I get a little bit tired of this cult of just the founder. I actually don't believe that. If you want my note of an underrepresented function, it's sales and marketing. Sales and marketing can make or break your startup. If you pick the enterprise channel when you should be consumer, you're going to run out of money. If you pick the wrong strategy. And so again, those are some of the things that I think about. And the good part about entrepreneurs is they self-select. They pick the type of investor that makes sense. And Brian, I really like what you said. The best entrepreneurs, they look for superpowers. Brian's got a superpower in food tech. He can find another superpower with maybe somebody like my background with hardware. And together, we can create a syndicate that can create a really strong company.
We're creating the Justice League of investing here, right?
For the win.
Next time you see us, we're going to have our costumes ready. I liked what you said also just about applying a SaaS model to hardware. It's the same problem I think that everybody in this room has seen is applying any kind of tech metric to food, right? I mean, like food just does not scale in the same way that that social media, that any other kind of SaaS platform, even SaaS platforms around food, it just does not scale the same. So I think we've definitely seen over the years a number of tech investors come in thinking, I know tech, to Brian, to your point, I know tech, I understand how SaaS should work, but having a huge misunderstanding of how the food system and all the different, all of the different players within the space interact with each other.
It's easy to take a look at an incumbent, a large brand that's all over Kroger or Walmart or Whole Foods, and say they don't know what they're doing. They only spend X% of their revenue on R&D. That's not the case. They're very smart and very sophisticated. And the better startup approach is how you can work with them to actually uncover this innovation. In the case of August, we were the #1 selling smart lock in the US. We sold 2 million smart locks. We also worked closely with all the 3 major vendors that are on 95% of the doors here in the US because we knew at some point we needed their distribution. Something that you had in your food tech landscape that I thought was really awesome was a breakdown of all the different categories. And so something that I thought was really compelling is where I spend a lot of my time is thinking about the enabling tech. Yep. Tech that actually can solve a well-articulated problem, but in a way that's using sensors, AI, machine learning, or robotics that has differentiation. And so 2 areas that I've invested in personally that I think are quite interesting. First is around the supply chain side, so asset tracking. I backed a company called Shoof, SHOOF. It's basically a tile for the enterprise. Over a 20-kilometer range, it can locate a pallet with 1 meter cubed. So imagine if you're at the distribution center or at the location and you're trying to determine, here's something that's perishable, and here's a bunch of things that I can wait 3 weeks, especially when we come to the holidays, things like Thanksgiving, Christmas, that's very important. The second is I made an investment in a company called Pattern Brands out of New York. You may know their previous name, Gin Lane. This was the creative agency that did work for Hims, Shinola, Warby Parker, and Sweetgreen. So some of that really awesome millennial branding. That company, Pattern Brands, was funded on a deal that I sourced to Kleiner Perkins and ended up coming out with a cookware brand that launched a few weeks ago called Equal Parts. One of the things for the entrepreneurs in the audience to think about with challenger brands is at a certain point, whether you have a mattress or a pair of shoes or a new type of glasses, you're going to reach an asymptote where the cost of acquisition for a customer becomes higher and higher. And at some cases, your business will stop around $20 or $30 million in revenue. So this company realized that there's a benefit to these conglomerates like a Mondelez or like a Unilever, and they're going to build multiple millennial brands. And so I'm super inspired to be here. Want to thank the Smart Kitchen Summit team, and also just to the entrepreneurs quickly. Always believe in what you're building, but you have to be mindful to have that tough opinion from a friend or somebody in the industry. You are always looking for signs that you're doing this thing late at night, on weekends, losing friends, losing sleep. But if I could tell you, when I see an entrepreneur who's world-class and she's working on a problem that's too small, you need to be the catalyst that can say, hey, there's a massive problem out there. We have, hunger problems, we have education problems, we have safety problems. Let's work on harder problems. One of the tough things about venture is you see a lot of incrementalism, and incrementalism sucks. I don't want 10% better experience in education. I want 100x better, right? I don't want 10% cheaper food. I want significantly cheaper food. Thanks.
But you have to pay the producer as well. So.
Correct.
So I think talking about Unilever brands, corporate strategy, it's a good segue. We have Tom Allison here from ZX Ventures. Tom, you're wearing a bit of a different hat here. You're looking at investing through a very strategic lens. I think, ZX Ventures is unique because it's self-described as a growth and innovation group, not just a corporate venture capital group. So you're in charge of investment strategy and M&A. Can you talk a little bit about your lens on investment? What stage, just for the startups in the space, in the room, what stage are you looking at? What problems are you looking to solve? Are you looking at broad industry kind of CPG problems, or are you looking at purely strategic to A, B, and Bev opportunities?
Sure. Yeah, a lot there. So I'll try to unpack it. And I feel like I have to defend all the corporates because everyone's beating us up on the last panel, on this one. So I'll try to do my best. But I think some of the critique is justified, right? So glad to be here. Thanks for having me. So I lead broadly corporate development, but M&A investments for ZX Ventures. So ZX Ventures, if you don't know, is the growth and innovation arm of AB InBev. So we're a fully independent organization, a separate LLC from the core business, but fully owned and on the balance sheet. And just a bit of the backstory. So we were set up through a mandate from the board, and the board really said, and I think this starts to address part of your question, but the board said, hey, we need to get ahead of consumer trends, right? We need to really think about the consumer in a new way. We need to use different lenses. It's really difficult to do that inside of a big organization, regardless of how kind of nimble or efficient a big company is. It's not going to be as efficient as a small, kind of fast-moving independent company. So they said, set this up. You guys, hire new people, bring in some people from the core business, and go solve consumer problems. You know what I mean? And do it whatever way you want. You have an envelope. We'll write you a check. Go solve these problems. Go figure out what the problems are, and then solve the problems. So now, about 4.5 years in, we've been extremely active. So over 70 investments across venture and M&A globally. We operate in 6 different zones around the world.
I think that's something that struck me, is that I've had probably 10 different conversations with your colleagues, and some of them didn't even know the other colleagues. So how that just shows how big of an organization you are. How many people are in ZX Ventures?
Yeah, I can't say, but it's in the thousands.
Okay, yeah.
So it's
not surprising.
Yeah, I think it's important to point out
that's pretty impressive and unique, I think.
It is. It's a very unique organization. I think it's important to point out that we have operating companies, right? So there's companies we buy, and we integrate, right? And we operate those companies. So it's like a more of like a private equity shop, right? And then we have a venture fund that sits inside of ZX as well, that we're investing out of into traditional venture deals. Right, so it is an organization that is large. In 2018, we contributed to 10% of ABI's growth year over year. Came out of our portfolio companies, so we're pretty proud of that.
Right, revenue growth.
Revenue growth.
Wow.
Yeah, and when you're talking about a company that's doing over $60 billion in annual revenue, it's pretty significant. Yeah. So. We've I think made a lot of mistakes along the way, but learned, and we kind of iterate, learn, and improve our model. I think one of the big improvements we've made recently is really separating our M&A function from our venture investing function, and even within venture, splitting out our venture thesis separately. So we have because what we're looking at is so broad, right? We're looking at technology investments, we're looking at consumer products, we're looking at new business models for the core business. So now we have a M&A layer, and we think of M&A as a tool. We have a venture layer. We think of venture as a tool, right? And then within venture, we have sub-funds, right? So we have a fund focused on technology, and it's really technology that helps our core business. We're looking at everything from, like you were alluding to, farmers. What are the solutions that farmers need, right? And they need banking solutions, right? So we're investing in blockchain startups there, all the way through to logistics solutions for our core business. How do you create more efficient matching of loads with drivers, all the way through to last mile delivery in Latin America? How do we give our consumers more convenient access to our products and also help deliver them value? So on the technology side, it's really thinking about solutions for the core business that help the core create efficiencies, connect with consumers more effectively, or otherwise, right? On the product side, we're thinking about what is the next billion-dollar brand, and I know there are some people that say there will never be a new billion-dollar brand created, right? That Chobani was the last billion-dollar brand. We believe, that with the kind of assets and the backing of a company like ABI, matching that infrastructure with the right entrepreneurs, we can get there. So that's what we're searching for in product, and then in new business models, we're really thinking about. What are the assets or the underutilized assets that a company like ABI has that we can tap and create completely new business models? The example here is we're looking a lot into protein, right? So we're sitting on a lot of spent grain, right, as a byproduct of the brewing process. It's actually very high in extremely high quality protein and fiber. So we've made some investments into startups that are innovating in this space and that have technology that can extract protein from spent grain, because we see this as a multi-billion-dollar business that's a B2B business, different from selling a product to consumers, but is a huge untapped opportunity for the core business that we can support through venture investments.
Right. And even the processing of that, the fact that if you have that in-house, then you're not transporting. One, you're driving revenue out of it, you're upcycling it, positive story, yeah. But then you're not also shipping around water as well. You're taking care of that at the source. The answer, I'm sure, is many different layers. But how are you? At what stage are you working with companies? What's an ideal company to approach you? For the startups again in the room, help me understand kind of the life cycle of your relationship with a startup.
Yeah, it's tough, right? Because I think the different vehicles we have are looking at companies in different stages, right? On the technology side, we're typically looking at companies that can already support our core business. So they are later stage, these are like Series C, Series D stage companies typically, usually have already run a commercial pilot with our core business or have meaningful revenue that they're already generating from our business. On the product side, we're mostly looking at companies between $1 and $10 million in revenue. with a clear path to 25, in the next 12 to 18 months. M&A, we're looking at stuff that's, I'd say, over 25 million in revenue.
And in terms of working with, so if you're working with kind of Series E and later, you don't have exclusivity terms tied to your investment, I assume. But with the earlier stage teams, are you structured like a typical CVC? Is there linkage back to the parent company, or you see yourself as a standalone investor?
No, I mean, we know that our proprietary advantage is the core business, right? So if we can't figure out how to leverage the core, then we're in a more difficult competitive space to win deals, right? So I think when we pitch, ourselves as an investor, the key piece of it is integrating with our core business, right? And we need to be able to figure that out. And I think we've done a lot of things, to make progress there. And I think we've seen some great successes. On terms, on the venture side, we don't attach any harsh terms, right? In many cases, we're not taking board seats, we're taking board observer seats. We're not putting in place ROFRs or any kind of additional, burdensome terms on the entrepreneurs. I'd say on the beverage side, if it is something that we see, as a path to an M&A pipeline, we might, if it's win-win for the entrepreneur. That's one of our principles around our investment is create win-win structures, right? So, and what we've seen is when those structures are truly win-win, those are the success cases, right? And if we're good partners, then they'll choose us when it comes to selling their business down the line.
Yep,
anyway.
Absolutely. So I'm going to take this to everybody now. We're going to step back, have a little bit more of a moderated discussion between everybody, and I want to start off with an easy one, just to get some banter going. Do you guys have a favorite food tech, either product or service that you guys are using right now that you want to proselytize? That's not a portfolio company.
I'll start with this one because about 2 years ago, I redid my whole kitchen in our house. And so from the ground up, we got to decide what equipment and services and things we want in the kitchen. And for people that know me, I'm a techie nerd. I play with every gadget that's out there. But we went completely non-techie for all the stuff. I did not buy the Samsung smart fridge. I did not buy a connected oven. I did not buy, we went very traditional. But I would say the one place that I spent a lot of time thinking about was obviously coffee. And so coffee is the one legalized drug that we all consume at least 3 or 4 times a day these days. And so my favorite product in my kitchen right now is a product by a company called Fellow Products, and they make a kettle. And all it does is one thing just beautifully well, is it hits its temperature perfectly every time. And I noticed one other thing, and I want to mention this, which is they have a UI design that now I've seen that is now being replicated in a lot of other devices, which is it's a simple knob. It's a push and turn knob. It only has 2 functions. You turn it to set the temperature, and you push it to start. And so I just noticed, and I bought this really nice, I love my lattes in the morning. I bought a really nice Breville, milk frother. It has exactly the same design language. And I'm like, wow. I'm like, if we get into the simplicity of technology where it just kind of fades into the background, it just does its job so well, we'll miss all these little subtle cues of how to build good integrated hardware, software solutions. And I say this not saying oh, you should stop building this smart tech for the kitchen. I go no, that's the goal of technology, is it just becomes stupid and in the background, and it just helps make our lives so much better that we don't even think about it. And so it was funny when you mentioned this question, I'm like, now I got to think about it. What technology do I have that I really, I'm like, oh, it's the simple stuff that just do that thing really well that make my life a breeze. And I'll go with coffee-related stuff.
I think building on that, I think because there's been so many tech investors in the food space, and there's also content has been kind of a big category in this space. There's such a focus on engagement. What are your engagement metrics? But I think exactly to your point, I think a lot of success in this sector is actually not engagement. It's not active engagement, at least. Engagement passively. It sits there, it does its thing, you move on, and that's what true success is.
By the way, I mean, that's one of the dangers of connected home, right? Is this sort of attitude that there has to be engagement and all these things. If I step back as a consumer and say, well, what's the value proposition of a smart home? Well, a smart home should do these things for me that give me found time. So technically, right, if we think of mechanical advantage, I'm not like carrying stuff by myself. I have a backpack, we have cars, all those things. So if I end up taking the same 3 hours I was going to prepare a meal, and now I'm doing with a bunch of these other gadgets, I don't get any more found time. I have no leverage. And so somewhere in this attention economy where everybody's trying to get a piece of it, I think those best user experiences, they do what they say, they actually speak to the brand, and it's like the Arthur C. Clarke quote, right? The best technology is invisible from magic. It's not distinguishable. So on the question of what device, my wife and I have 3 kids under 8 years old, and so I'm in the air fryer mode right now. I have to somehow get 20 chicken nuggets ready for kids in about 5 minutes, or else they go bananas. So I'm an air fryer person.
Wait, I got a follow-up question for that real quickly, which is single-purpose air fryer or multi-cooker that does air frying as a feature?
We have the multi-cooker, yes. Yes. And I'm a pour-over coffee person.
Tom, what's your favorite?
Yeah, I think I have to plug the DrinkWorks device. I don't know if anyone saw it yesterday. As we're part of the same company, but actually the first time I ever saw it was here yesterday. So I should have, I'm hoping to get one eventually this holiday season once they come to my area. But no, I mean, one of the things that we look at a lot is, where is the consumer going? And we look at more RTDs, right? And one of the insights we found was that the consumer is really looking for convenience, quality, and value. And how do you deliver that in a meaningful way? It's like taking water out of the supply chain, right? So I think what they've done with DrinkWorks is really compelling, and I'm excited to see where they go.
So on to a more serious topic. I want to leave a little bit of room for questions at the end, and if you guys don't have questions, then I have some more stuff. But so, as I alluded to in the beginning, we've seen over the last couple of years a lot of go big or go home folks just simply go home. The last couple of weeks even we've seen kind of the public markets rethinking valuation of operationally intensive tech-enabled businesses versus pure-play software, and I think that has a lot of implications for a lot of well-funded players in the food tech space, just in the private market as well. Talk about some of the categories that you guys are most excited about that have this high growth potential, but also high return potential. Brian, you want to kick it off?
Yeah. So one of the ones that we're spending a lot of time in right now is biology to make better food. And so there was a great talk by a woman yesterday about we as humans domesticated plants, then we domesticated animals, and now we're domesticating microorganisms. And so like thinking about that as a thesis of how we're going to change agriculture and food production to scale rapidly to meet the demand of 50 billion people on the planet, 10 billion people on the planet by 2050, and to basically feed them higher nutritional quality products. And then also think about the other macro problem, which is the world is changing its climate. And we can't get away from the fact that it's going to be harder to grow some things that we find to be commodity products today. And I'll go back to my love of coffee. Coffee is moving up the mountains and getting harder to produce and harder to pick. And so we get up and we take for granted the fact that we go to a Starbucks and we get our $3 or whatever cup of coffee these days, or you go to a Blue Bottle and get your $6 $6 latte. But those prices are going to rise. It's going to be harder to make those products. And so again, I'll pitch my next session. Atomo Coffee is making coffee without the coffee beans. And so this is fascinating to me. When we can rethink products from the ground up, and then there's a panel that's going on alongside of ours right now in Cell Ag, or what's going to be called cultured meat products. If we didn't need the cow to make steaks, how does the food system change? I mean, one of the companies that I really love is the one that doesn't use hops to make beer. But they're creating the same exact simulation of the flavors because they understand how to generate those chemicals that trigger the same receptors. And I go, that's going to unlock a whole lot of potential. And so there was a conference that I missed, unfortunately, in San Francisco last week called SynBio Beta, where Eric Schmidt, the guy is basically one of the pioneers of internet technology and internet services, basically said biology is the new internet. And that really struck me as like, oh yeah, this could be big or bigger than the internet in terms of business opportunity.
We are very interested in biology, but I mean, I think you just went into detail on it, so I won't. But I think when we think about the opportunities with fermentation, and applying fermentation technology to new products, it's super exciting for us. But just to take it in a different direction, one space that I'm very interested in is thinking about how to automate labor, particularly with last mile delivery. So the gig economy, I think is we're seeing, like you alluded to with Uber, is really reaching the scale limits of software, right? So the next, if like the last 5 years were dominated by kind of building software platforms, labor-driven software platforms, I think the next 5 will be autonomous, right? So how do you then automate that labor so that the unit economics make sense? And that's how you can create the next wave. So we've invested in companies like Starship, which is a delivery drone, right? We have investment in Rappi, which is a last mile courier service in Latin America. But I think what we're seeing is connecting those two, bringing in kind of the technology that the autonomous technology is really the way to break through on unit economics.
Weren't you one of the guys that did the first autonomous trucking delivery too? Wasn't AB the first guys that did that as well?
We did, yes.
Yeah. So you guys are investing a lot in that space. Yeah. That's awesome.
It's probably apropos just to think about a lot of the times when startups are addressing a problem, they're thinking about revenue enhancement either for the company or for their partner, but there hasn't been a ton of focus on OpEx reduction. So even when we think of logistics, Brita, in our pre-call, you asked about the August Access program. We worked with Jeff Bezos' team at Amazon and with Doug McMillan's team at Walmart. The idea of unattended delivery inside the front door using a smart lock was not only helpful for customers, who can't make that extra trip to a grocery store during the week, but also if we think about waste and cost, it's extremely expensive to deliver packages to the front door. In fact, the average package is delivered 1.6 times using extra gas, brakes, et cetera. And so that's an area that I think is quite interesting, that supply chain. When it comes to robotics for last mile delivery or drone delivery, et cetera, I think one of the things to be mindful of is the regulatory frameworks. If we think about like what happens in a bike lane, anything that's motorized over 8 miles an hour can actually be regulated. So if you're investing in Kiwi and some of these other places, you'd be very mindful of what the regulatory framework is. Things that are interesting to us as a fund, I'm using your categories, Brita, from that awesome, I'm plugging it twice, so you definitely owe me a beer. I love on-prem retail tech, and I'll just give you some of the things that I'm seeing that are quite inspiring. There's about 43 venture-backed LiDAR companies out there, and autonomous vehicles is a $0 trillion market. That same LiDAR array could actually be used in a retail environment for intentionality. So intentionality is that LiDAR understanding the difference between a UPS driver and a kid coming across the street with their ball. Inside a retail store, if you've ever had the experience of going to Home Depot and waiting in the middle of the store for a store associate to sell you something, that's a big difference between understanding shopper, are they browsing or are they purchasing? The ability to get a store associate to somebody who has purchase intent quicker helps Walmart, Best Buy, Amazon, everybody. So that's an area. Supply chain transparency, which you wrote about, which I think is really interesting. Not only root of trust, I want to know with fidelity that bottle of whiskey that I buy or the tomatoes are coming from where they say, but also in terms of reducing waste. One of the things that's inspiring about food investing in general is the fact we produce, but we also waste. Something like 40% of the food that we create is wasted. And the last is really thinking about what happens in that retail store, not only from the intentionality, but the point of sale checkout. So one thing that we're actually seeing right now is the tie-in between point of sale systems and fraud. And so I can't name the company, but I saw a really interesting company last week that was actually tying the point of sale data to a camera, and one of the things that they were measuring is if there's a bunch of theft at the store. So traditionally what you have to do, if you're a small business owner and you have a camera and you're losing a lot of product, you're not going to look at that camera, all the footage for these things, and pick out a person. You actually need to tie that to what was checked out at that time. And so those are a couple areas. And then one last thing, just in terms of the capital markets. People raise money when the cost of capital is low. And for a lot of these companies that have been blitzscaling, capital has been almost free. That is about to change dramatically. And so, I was an investor and an operator when a lot of us got started in the early 2000s, been through 2 crashes. What I would say is you need 3 playbooks. You need the I'll never raise another dollar again playbook. You need the I'm going to raise the next level of VC funding. And then if Masa's son shows up at your house on a Sunday from Japan and says, hey, I really love your smart kitchen camera refrigerator robot company. Here's $100 million. That third one I'd never use. The other 2 might make sense.
Yeah.
That's really as likely as winning the lottery, to be honest with you, in most of these cases.
Yeah. Those times are changing.
So thank you. I think this is great. I have a couple more questions, but we have a couple minutes for questions. So I will turn it to the audience. And if you can speak loudly, I will repeat your question if everybody can't hear. Audible to me, and then I'll repeat the question. So I'm going to start. So he said, question is to Nate. He talked about working with the top lockmakers.
So what sort of partnerships or what sort of engagements were you having with them during that time to also ensure that they never saw you as a threat?
So how did you structure those relationships so that they didn't see you as a threat or vice versa?
Yeah, let me tag team it with Tom because we can take it from the entrepreneur side in the larger company. Our view was always that August was a software company, an API for the front door, and that the larger lock companies had amazing distribution, intellectual property, but their core business was bending metal. And so one of the things that we tried to do was every quarter, every half year, sit down with them at trade shows and say, hey, we're going from a place where there's zero trust. You don't trust us. You're an incumbent. We're getting all this press. Let us build trust by talking about what we see together. What are the opportunities to create new products? What are the opportunities to share distribution? Are there, Yves Behar, the designer, was part of our founding team. How can we work, maybe create a lock together? Over the period of 1 or 2 years, we started to get more trust that what we were saying, like, this is going to happen. Okay, they believed us. And then the final thing that led to our acquisition, we had worked closely with Amazon on the requirements of their in-home delivery, the Key program. They released an RFP to all the lockmakers about, hey, do you fit our specs? And then once that RFP was released, they all called us and said, you've been telling us this for 2 years. We didn't believe you. Now all of a sudden, your lock conforms to the specs. And so I always think it's helpful, even if you think they're a direct competitor, is to share information, to talk about the market and engage, because most startups do not end up as public companies. They talk to corp dev people who validate the business. And so you want to build that trust. The last thing I would say is investors, corp dev people, people who take companies public, they want to see the motion picture, not the snapshots. If I meet you today, I take a snapshot. If I meet you 3 times in the next year, I have the motion picture. I can see how you mature and change and thinking. And so it's very important that you show people more than just one snapshot.
I'd say on that front, though, it's also very important to accurately represent where you are in terms of growth. Because if you're projecting a little bit too much and then somebody sees you in 6 months, they're like, okay, how is that growth? And you don't have that to show, that damages your credibility pretty quick.
What is your thought in terms of, you see so many startups a year, what's the right engagement model?
Yeah, I think I'm glad that you talked a lot about trust, because so much of it is the personal relationships. You know what I mean? And I think the people that are more open, the entrepreneurs that are more open, are generally the ones that we partner with later on. You know what I mean? So there's always a balance there, because there's IP. There's, even when you get into a contract with an entrepreneur, you know what I mean? Sometimes there's stuff that they don't want to share, or we don't want them to share. But I think being super clear, being super open, honest, building trust-based relationships. But then if it is a contractual discussion, being super clear on what IP belongs to who, and any IP that's created together, what happens to that and who owns it in the end is really important. And just setting expectations throughout the process and making sure that everyone's on the same page. But there's no silver bullet on the engagement model.
All right, we're a couple minutes over, so if you want to ask us any other questions, we'll be over there. Thank you guys so much. This was great conversation. We're going to give them a round of applause. Thank you again.